Yo, let me tell you about a pioneer, David Schwartz in the blockchain sphere. From the roots of code to the heights of fame, in the digital ledger, he made his name. In the shadows of Jersey, where tech dreams start, David Schwartz, with a mind and a heart, engineering talent, a vision so grand, he saw the future in the blockchain's hand.
When we originally developed the XRP Ledger, it was Arthur Brito, Jed McCaleb, and myself. It's an interesting path. So I first started finding things to do with Bitcoin. It was late 2010, early 2011, and I was basically just bored. And I found a website called Stumble Upon, where you kind of tell it what you're interested in, and it tells you what it thinks you should be interested in. And so I looked at Bitcoin, and I just immediately realized, wow, it just seemed like all the pieces fell together. And I decided that I wanted to, learn what was going on. I joined the Bitcoin Talk forum, which was probably about the only Bitcoin forum at that time. Maybe there were a couple others. And I started looking at the software to see how was the engineering designed, and I started participating in the community, and it just accelerated from there. I just realized immediately that was the right thing for me to be learning about and messing with. One of the ideas that we realized early, at the time, a lot of people were thinking Bitcoin would take over the world and everybody would use Bitcoin for everything. It's hard to just sort of look at something randomly and learn it and understand it. So I looked at what issues people were having. Mining pools were just starting to come to the forefront, and they were running into limitations. The Bitcoin software was never designed with mining pools in mind, and there were some limitations they were running into. And so I started solving those limits, and I got bounties in Bitcoin, which is like, hey, that's real money. That's a cool way to get paid. I started accumulating a little stash of Bitcoin. And then I realized I wanted to do something professionally that involved the cryptocurrency space. And of course, there really wasn't much of anything at the time. And that was when Jed McCaleb found me. And he had the very, very beginning of the germ of the idea that became what we now call the XRP Ledger. And so he and I met at a coffee shop in Oakland. And, we exchanged resumes and ideas, and that kind of it grew from there. Bitcoin was not going to become the one currency that would just take over the world. Just the opposite. It was the first of some 1,500 cryptocurrencies, most of which don't interoperate. So it actually recreated the problem that it was never going to solve directly the interoperability problem. It was actually going to create a newer version of it. And we had the idea that the ledger should be multi-currency, multi-asset. That even if Bitcoin's going to take over the world, you still have trillions and trillions of dollars in legacy fiat assets, right? Like the whole world economy. And so you have to work with that in some way. And just saying the Bitcoin blockchain will only deal with Bitcoin is just not, there's just no way to get from here to there, even if you think there is where we're going to get. And so we built it as a multi-currency ledger from the ground up. What we did is we built a liquidity system into the XRP Ledger. We built a decentralized exchange, again, in late 2011, early 2012, between all these issued assets. And I think one of the coolest things that we did that I still think is pretty amazing is that we integrated payments with the exchange. So normally payments have a certain semantic. Like if I'm going to pay you $50 and I have euros, I want a quote, and the payment is sort of one shot, and either you make it or you don't. And then you have exchanges where you can place offers, and there's an order book, and offers can partially execute, and you can place an all or nothing, and there's market and limit, and they're semantically very different. But an interesting thing is that exchanges tend to be very cheap and payments tend to be very expensive. So if you can build an adaptation layer that makes payments through an exchange, there's tremendous value in that. And we built that into the XRP Ledger. And it's very sophisticated. Let's say you have XRP and I want Bitcoins, and there's someone I trust to owe me the Bitcoins, some sort of counterparty that I trust. And there's liquidity. There are people who are willing to trade dollars for Bitcoins and XRP for dollars and whatever. The payment engine will look at all of that liquidity and find a path to allow your payment to take place that doesn't draw down any single order book too far. And it has both series and parallel execution. So series meaning you could go, dollars to XRP, XRP to Bitcoin, Bitcoin to Ethereum. And then in parallel means you can draw down more than one path at a time so you don't take an order book too deep. And we built accounts as fundamental things on the ledger. So unlike Bitcoin, where outputs are the fundamental thing, you have accounts which have properties, and you can manipulate those properties, and you can specify what assets you're willing to be paid in. If you look at the XRP ledger, you look at the Bitcoin blockchain, if you could break those systems, you could make billions of dollars, and they're completely open to the world. they have proven a level of resiliency that these closed systems just don't than they were. One of the nice things about the way Ripple networks, the payment side of Ripple, that's, not the XRP Ledger side, but for that Ripple net payment system, although it will use cryptocurrency to settle, the customers who are making the payments are not exposed to the crypto in any way. Like, they just make a fiat to fiat payment. And so it's nice for regulators and it's nice for the banks that sometimes we'll have regulators will say, hey, you can't, Joe's paying Mary, you can't use a cryptocurrency. Like, well, Joe never owns the cryptocurrency. Mary never receives the cryptocurrency. Then the volatility is only the institutions are exposed to the volatility. And effectively, from the point of view of the regulators, the crypto was sort of like an internal treasury management function of the payment company. And so that made regulators much more comfortable, which of course makes banks much more comfortable. But of course, there's the separate problem of like, okay, that's great that they're using cryptocurrency for their payments and internally, and it's making things faster and cheaper. But that isn't really pushing too many of the benefits that cryptocurrencies can provide to the customers. And so figuring out how to do that is going to take them continuing to get more comfortable. I think the Bitcoin ETFs will probably help with them getting more comfortable. And then there are some countries where the regulatory environment is much better. And so there's that level of comfort. And you will start to see financial institutions sort of pushing cryptocurrency services to customers, particularly small to medium-sized ones that are looking for some edge. Like the larger ones don't feel like they have to do that. And I think you'll see the same thing with the Bitcoin ETFs. I think we already saw one of the largest brokers saying like, we're not going to touch these things.
Yeah, it's funny how that
works. They don't have to. Yeah. Right. Yeah. But imagine if all the big guys said that. Well, then all the small guys are going to be like, come to us. It's a competitive world. They're not going to be able to keep their customers from getting the financial products and services they want if their competitors are offering them. So it's going to be interesting to see how that plays out.
Now, I know the community is going to want me to ask, and you probably can't give names or whatever, but if you can give numbers maybe as far as how many banks you're working with. And I don't know if you know this number at the top of your head because you guys are constantly growing and so forth. But maybe how many banks you're working with, and are there new banks that have been brought on board recently?
I don't have that information offhand. I know that we do continue to, we're constantly continuing to grow the network, and there have been a number of them that we've disclosed. And I could also say that like new growth from RippleNet it's all going to be people who are using cryptocurrencies to settle or stable coins or some of these sort of blockchain technologies that we're not particularly looking to grow the sort of pure. So in the early days of RippleNet, you could use RippleNet to settle, and you could provide, Forex. You could provide a Forex rate. Let's say if you just want to use it for messaging, let's say you said, look, we don't want to use Swift for messaging, we want to use RippleNet for messaging, but we still want our internal Forex desk to provide all the rates. Or it's not even a foreign exchange application. It's all, US dollars, or it's all Mexican pesos or something. We brought on those kinds of customers for a variety of reasons. One being, when it's hard to find customers, you don't necessarily want to be too picky, but also it's like the value of a network is the number of things that you can reach on it. Like, even if there's a website that doesn't add much value to the internet as a whole, it isn't like of strategic value to the internet. The fact that there's a long tail of stuff that you can do on the internet is part of what makes it attractive. Like, whatever you want to do, you could probably do it on the internet. If not, you're like, well, why not? And so it's this idea that like anything the network could do would increase network effects and increase the value of being on the network. It would increase the number, even if they weren't strategically valuable to Ripple. It didn't matter. It still makes sense to grow. Just like Google wants as many websites to be on the internet as possible, even if they don't produce any, even if they don't fit any of Google's strategic direction, because somebody will use them, and that person is another target customer that Google can offer their services to. The same kind of logic applied, but new growth is all going to. We're very focused right now on blockchain settlement.
So the founding story of Ripple dates back to the day when the only cryptocurrency that exists was Bitcoin and a couple of clones that were essentially identical copies of Bitcoin. No significant changes to the architecture or the code. And it began with an idea that proof of work wasn't what made Bitcoin so special. So at the time, because proof of work was the biggest new thing in Bitcoin, there had been a number of previous cryptocurrency type projects that didn't really get off the ground, like B-Money and Hashcash. And the thing that made Bitcoin different from its predecessors was proof of work. That was like the incremental improvement. And so it's natural to think that if Bitcoin is like so much better than its predecessors and proof of work is what's new in it, that proof of work is what makes it so much better. But what we started to realize, even back then, was that what made it so great was the fact that the ledger is public, that it's a distributed ledger, that everybody knows what the transaction rules are, that transactions are public, essentially the lack of administrative functions, that it was decentralization that made Bitcoin so great, and that essentially proof of work was just how Bitcoin solved the double spend problem. And the other thing that we started thinking about in the early days was that people were saying that Bitcoin would be great because everybody would just use Bitcoin for everything. But every payment system is great if everybody uses it for everything. The problem with payment systems is that there are so many of them, and there aren't a whole lot of them, they're for no good reason. It isn't just that everybody created their own because, they have different features, like they are in different jurisdictions. There are payment systems that are tied to jurisdictions. There are payment systems that have very high-speed payments. And if you think about it, the way you buy a multi-million-dollar piece of property and the way you buy a stick of gum probably shouldn't be the same. Like, there's very good reasons why they should have different characteristics. And so what we started to think about was a payment system that was decentralized, that had the features that we thought were the best about Bitcoin: no administrative functions, decentralization, everybody can enforce all of the system's rules, but that was a multi-currency system that could be faster and cheaper. We also kind of bought into the be your own bank, no middlemen, and miners or block producers are middlemen in the sense that they have interests that are different from the people who transact, like they want high transaction fees. Whereas obviously if you use the system, you probably want low transaction fees. So to focus on this sort of rapid, low-cost payments, cross-currency, cross-issuer interoperability, we designed the XRP Ledger roughly June of 2012, and because it doesn't have proof of work, there's no way that it can allocate currency. So it has 100 billion XRP. Initially, it just sort of sits in the Genesis account. And we built what we thought would become a new approach to global financial transactions. In about September of 2012, Jed McCaleb, myself, Chris Larson, Arthur Brito, a couple of other people, Stephen Thomas, created Ripple, the company, to develop software to support the new financial infrastructure, to distribute XRP, and to use XRP as a bridge currency, like in payments. It wasn't that long before we figured out that like institutional adoption kind of wouldn't happen by itself. We're also a key contributor to the XRP Ledger, bringing features like real-world asset tokenization, DeFi, new features like the automated market maker. Our focus as a company has been very much on financial institutions using digital assets, XRP, to lower costs with cross-border payments, using it as a source of liquidity, using it as an intermediary asset. But because it's a decentralized ledger, everybody's welcome to use it, however they want.
Awesome. Great overview. So we have XRP, the cryptocurrency, XRP Ledger. That's the network, the distributed network or blockchain, and Ripple Labs, which is the company building for XRP Ledger. I understand there's also something called RippleNet. Is that right? Is that also a part of the ecosystem?
So RippleNet is it's a division within Ripple. I guess we call the product Ripple Payments. But the idea is to provide institutional payments that can settle with digital assets like XRP. One of the problems that we discovered really quickly is that you kind of need to get institutional adoption. If you look at features like the internet, a lot of the early adoption was universities, it was military, it was large companies, and that kind of paved the way for more grassroots adoption. And everybody in the industry was focused directly on grassroots adoption. So we realized somebody would have to make institutional products. Like if banks were going to use digital assets to settle their payments, somebody would have to make bank-grade software and systems that could settle with digital assets. And so we developed, gone through a number of name changes. We currently usually call the product Ripple Payments, but the division inside the company that builds this is called RippleNet. And this is a proprietary product. It's owned and managed by Ripple. It's sold to financial institutions, mostly non-bank financial institutions, but also banks, payment companies, large corporates, to make institutional payments. And a big feature of RippleNet is that it can settle with a digital asset. It doesn't have to. So you can use it for, any number of payments use cases. Many just don't fit a digital asset. For example, if it's domestic payments within divisions of the same company, it would be really weird if one branch of a company owes another branch of a company in the U.S. dollars, it'd be weird to settle with XRP. But you can settle and also like in the early days, there were very few payments that could settle with XRP. There weren't a lot of corridors. There wasn't a lot of liquidity. That's increased significantly since then. So the idea is get institutions using a payment system that can settle with XRP. Then as the infrastructure, on-ramps, off-ramps, and liquidity is available, there's no obstacle to them using XRP to settle their payments. So that's RippleNet. You can kind of think of Ripple as having two halves: RippleNet, which is like enterprise software for institutional payments, and then RippleX, which is all the XRP Ledger and DeFi XRP message that you can send. Like there's nothing you can tell my software that will cause it to make your XRP somebody else's XRP. Like Bitcoin has the same thing. Like there's no way in Bitcoin to say, hey, those 10 Bitcoin that belong to Alice, just give them to Bob for no reason. Like you must provide a signed transaction to do that. The only problem that you can't fix that, so virtually every problem is simply solved by the fact that every node enforces every rule. The only problem you can't solve that way is the double spend problem, right? The only problem that you can't solve that way is if I have 10 Bitcoin or 10 XRP and I try to send those same 10 XRP to two different people. And the only thing you need to do to fix that is agree on a global order. Whichever transaction comes first is valid. Whichever one comes second is invalid. What the proof of association process does on the XRP ledger is it globally puts transactions in order. And it's very binary. It's either working or it's not. The only way that you could sort of attack the XRP ledger was to stop that global ordering from working. And that would just cause the whole network to halt. So really the only plausible attack on the XRP ledger is just to stop it. And there's really no incentive to launch an attack like that because it's very hard to imagine how you would turn that into revenue or how you would benefit from that. And again, as soon as somebody caused the XRP ledger to halt, people would just stop listening to them. So proof of association means I listen to you and I try to agree on a global ordering with you because I identify you by some sort of identity. And so if you're just acting like a jerk and breaking the system, I'll just stop listening to you. So the idea is good actors will accumulate, bad actors will sort of fall by the wayside. But that also means that it can't distribute the XRP by itself, right? So like many blockchains like Ethereum uses proof of stake to allocate the digital asset. Bitcoin uses it proof of work. So the XRP ledger doesn't have any competitive process to allocate XRP, which is another reason we had to form some company. The AMM is live now. The AMM feature, was accepted. It was accepted by the network. It was voted on by the governance process and went live. And it's operational right now. It provides liquidity between any pairs of tokens on the XRP that are available on the XRP ledger. It integrates with the XRP ledger's order book system. We have a decentralized exchange that uses order book, which is generally more capital efficient than AMMs, but isn't as good as like covering a long tail of tokens. AMMs are a little less capital efficient in providing liquidity, but they also allow a return for the people who sort of lend assets to the AMM pools. Our AMM has a unique feature that we call the continuous auction mechanism, which essentially converts a lot of revenue that would normally go to arbitrageurs into yield for the liquidity providers. So it's a very nice and robust, DeFi platform. When the stablecoin launches, people will be able to create automated market makers that will trade between the stablecoin and any other asset on the XRP ledger. XRP obviously being the most obvious, an interesting one. Real world asset tokenization, a lot of the technical capability required to do it is there today. It's just a matter of getting companies, to build and launch. We announced a partnership with a company called Zonix, which is bringing real-world asset tokenization onto the XRP ledger. And then sort of on the other end of the spectrum is features like the lending protocol, which we announced conceptually, but it's in a very early stage where we're looking for community feedback and trying to make sure that the feature addresses, the needs that people want. I think it's worth pointing out an interesting difference between the way DeFi sort of happens on the XRP ledger and the way it happens on other blockchains. So typically on other blockchains, if you wanted to launch some new DeFi product or service on the blockchain, some developer would just write the code and then launch it as a smart contract on the XRP ledger. The XRP ledger currently doesn't support smart contracts. There's some efforts, including one called Hooks, that will bring that capability in the future, but it's not today. So what happens is when someone wants a new DeFi feature like the AMM or like NFTs when they were introduced or the lending protocol, they introduce it as a blockchain core feature. So that there's advantages and disadvantages. Again, I'd like to argue it's a better approach, but it has some disadvantages and it has advantages and disadvantages. So these XRP ledger core features that are built into the ledger One big advantage of that is these are very well thought out, carefully vetted, and the tools work well. So you don't have the problem that you might have with an Ethereum-based platform where you agree to some smart contract to do something and then it steals NFTs from you because there aren't smart contracts. Your tool that you're using to interact understands all of these DeFi capabilities because they're core ledger features. So they're all well designed. They're all very efficient. They're fast. They're cheap. The liquidity is concentrated. You don't have 800 dexes that spread the liquidity out. The disadvantage is you can't come up with an idea, write a smart contract, and push it to the ledger and have it working that afternoon. It means that the development and adoption cycle is slower. So you get these really well-built, really efficient features that cover 90% of what people want to do. But if you're in that 10%, you can't write your own smart contract to do it. Not today, maybe in the future with Hux. So I won't argue that it's better or worse. It does have a significant disadvantage in that the development cycle is a lot slower and that you can't, if you have some weird use case that needs a smart contract because you have some weird crazy thing that nobody else cares about, but it really matters to your business, you can deploy it on Ethereum, just have someone write the code for you. You can't deploy it to the XRP ledger, but you get these features that are very well thought out that address, very important use cases and that work together smoothly and efficiently.
Financial instruments, things like treasuries and securities, tokenized stock. I think that makes a lot of sense because where the benefits of what public blockchains can do, because public blockchains are sort of expensive. Like if you were a bank, you wouldn't put all your customer data on a public blockchain. It doesn't make any sense. They're expensive. You have to be able to get some real value out of that. And where I think that value is the clearest is in these financial use cases where you have people who don't have access to a good way to make a return. They can basically stuff money in their mattress, or their local currencies are subject to inflation, and they may not be able to adopt these sort of regulated things directly. Like they probably couldn't do business with Ripple directly, but they could get the Ripple stablecoin on a DEX, and they can have access to lending protocols where they could be the lenders. So they could get a return at very low risk without some company having to decide that they're worth serving because there may be challenges of scale, regulatory issues. So I think that's where that makes the most. And I think other use cases will probably follow on later. But I think where the money is, makes the most sense. That where the people are the poorest served, where you don't have to be fantastic to be competitive. If you have to beat out, companies like JP Morgan Chase have spent billions of dollars building these financial products that are very efficient for specific use cases. Like if you need to move US dollars to Europe, they've got that nailed. If you had to compete with them in that market sector to be successful, you would have to spend absurd amounts of money before you could ever do anything. So I think targeting the sort of long tail of underserved use cases where it's not profitable to build a product that's specifically, if you had to build the whole product just for them, it wouldn't make any sense. I think that's where that sort of long financial tail. And then it may, as you mentioned, all people, places, other things. Real estate, I think, makes sense because real estate is very expensive.
Yeah.
It's difficult to use it as collateral for lending. It's difficult to do fractional ownership. So where there are specific pain points and there's high value, that's great. Obviously, if there's low value, it's harder to justify spending money to fix the problem. And if there's no pain points, well, why would anybody care that you can maybe argue a theoretical advantage, but they don't see it tangibly.
And I would love if you, I know we talked about this last year just briefly, but I mean, the automated market maker, the AMM, is live,
yes.
Native within the XRP Ledger. What does this represent for you? I mean, what have we kind of seen thus far as AMM usage? And then how do you kind of envision that maybe transforming as individual knowledge bases get up, or maybe institutions want to start leveraging things like I'm just curious your thoughts as far as where we're at now with the AMM, and then how people, in your opinion, will leverage it maybe in the future.
I think it's a good example of the bridging between the sort of institutional use case and the sort of ground up use case. Institutional, there are going to be enterprise grade stable coins that are going to be the tokens that these AMMs are trading, but there are going to be participants who may be, underserved, who take capital, buy into the AMM, and then they can get a yield from providing liquidity. And then there's liquidity. It's a great mix. I think where the future gets interesting is where there's just more use of the liquidity. So if you're providing liquidity, your return is based on what the demand for liquidity is. And the demand for liquidity is not as high as obviously I would like. Obviously, how high it is, we would like to see it a lot higher. And so I think as these use cases, there's a sort of synergy. If people are using an asset for payments, then they need liquidity. If people are using an asset for loans and they're making payments, they need liquidity because they're going to be moving between different assets. So I think where there's that synergy where AMMs become part of a vibrant ecosystem where there's a lot of demand for liquidity. A supply of liquidity doesn't do you any good if there's no demand for it, and a demand for liquidity doesn't do you any good if there's no supply. And so I think growing those things where all of these use cases can sort of cross-pollinate and provide a sort of compelling, attractive sort of package for people.
Yeah, it's interesting. I mean, it's kind of like that kind of whole economy of aspects that are being built out kind of simultaneously. We had the opportunity to interview Anshul from RippleX maybe that was 3 or 4 months ago. And a really big focus, obviously, DID, so decentralized identifiers and digital identity. I'm curious from your standpoint, when you look at something like DID and like kind of this global standard that's kind of being worked on by a lot of different players, obviously, how you kind of feel that ties into institutional enterprise adoption. Obviously, when you think about identity on chain, you can start thinking about verifiable credentials and compliance aspects. I would love if you could maybe just walk us through that a little bit.
Sure. So imagine you want to onboard, you're an enterprise, you want to onboard some project onto the XRP Ledger or really anywhere in the DeFi ecosystem, and you have regulations of who you can do business with. So you may be able to enable DeFi use cases further down the line, but you can't do business with anonymous parties. You have to make sure that you're not, giving terrorists, people who are on the list of denied persons, all of that. Now, if you did all of that yourself, every customer would have to onboard with you directly. You would have a high cost in terms of verifying their identity. And the worst part is you have to store all the data. So now you need a cybersecurity, and if your data gets stolen, and it's terrible for your customers because one of the great things about DeFi is that we don't have to trust each other, right? We can have these enforcement mechanisms that make sure that you can't screw me and I can't screw you. But if I have to give you my identity, I have to trust your cybersecurity measures. And everybody says they're secure. It's very cheap to say you're secure. It costs nothing. It's very expensive to be secure. And one of the great things that decentralized identity does is it allows you to launch a regulatory compliant, let's say a stablecoin or a real world asset, or you want to tokenize securities of some kind, whatever you want to do, lending, you can do those things and you can onboard customers and you can meet KYC AML requirements without having to store all the data, without having to onboard the customers individually. You can decide that, hey, Fractal ID meets my regulatory requirements in the US, Jumio meets my regulatory requirements in these jurisdictions. And then you can onboard people through their DIDs, and then you don't have to store all the identity data. You don't have to figure out how you're going to do the identity verification. That's an amazing enabler for you. And it also means that if I don't know or trust you, I don't want to give you my identity information, but I can give you my DID because that's public. It only reveals the information if there's some regulatory need to know. You can onboard me as a customer without me having to trust you.
Yeah.
And so you don't have that barrier of we can't take on customers because customers don't trust us. And then you don't have the expense of having to secure that data. So I think that is a key enabler.
Let's talk about where the XRP Ledger has gone in the past, almost 12 years now? It is fully decentralized. There's more than 600 nodes processing transactions and maintaining the ledger. And importantly, each of those nodes enforces all of the system rules. And unlike on most other blockchains, those nodes are enforcing censorship resistance as well. There's more than 120 validators. We're probably the only major blockchain with no in-protocol incentives for block production or running a validator. People run validators because they want the network to work. They want the network to be robust. They want the network to be reliable and decentralized. They're run by individuals, businesses, universities. There's over 1,750 apps, exchanges on mainnet, built by a diverse set of global developers, many of whom in the room with us today. More than 2.8 billion transactions have been processed. For some time, more than 50% of transactions being processed on public blockchains were on the XRP Ledger. It's gone down a lot since then because the rest of the universe has grown, but the XRP Ledger has continued to process transactions at that high rate. No transaction has ever been discriminated against, filtered, censored, misexecuted, dropped, mishandled, right? It is a fair system because every single node on the network enforces that type of fairness. There's more than 5 million active XRP wallet holders around the world, and that's a real number. On a lot of other blockchains, for example, on UTXO-based blockchains like Bitcoin, a single user probably has a number of addresses. And so the address numbers may be very, very large, but those addresses don't actually reflect users, right? So those 5 million are probably real people who are using the XRP ledger, and they're using the ledger directly, right? There's a lot of people who hold Bitcoin, hold Ether, who will never use those blockchains directly. These are people who are actually potential customers for projects built on the XRP ledger because they have access to the ledger. They have their money on chain. Market capitalization of XRP is in excess of $30 billion. Makes it about the 6th largest cryptocurrency, depending on exactly what you consider to be a cryptocurrency. The number of contributors building projects of different types on the XRP ledger is enormous. As you can see on the slide, we have a large group of companies that are building wallets, custody, compliance, and security. These are tools that enable people to hold XRP, use the XRP ledger, participate in the ecosystem. Infrastructure, tools, and analytics companies. There's a lot of stuff going on the XRP ledger. The transaction rate is high. If you can't understand what's going on, you can't interact. Wallets need backends, right? There needs to be reliable hardware infrastructure. The gaming and metaverse space is a little bit on the small side, but it's been very exciting and interesting. Companies like Forte building interesting metaverse projects. And of course, marketplaces, DEXs, real-world asset tokenization and lending. These are projects building on top of the issued assets, the NFT technology, the DEX, the XRP Ledger's DEX. And then, of course, core ledger development. Ripple can't be the only people building, on the core ledger. Interoperability is extremely important. I'll talk more about that later, but we're not going to have a compelling ecosystem if we have a bunch of separate islands that have different functionality that don't connect. That's not going to be a great user experience. And then payments and stablecoins and on-ramps and off-ramps are absolutely essential. For most of us, it's not difficult for us to get money onto or off of the blockchain. A lot of us are privileged enough that we have money that we can play with on a blockchain that we don't even really think about as real money. In the early days of Bitcoin, we jokingly said, well, I have my bank account and then I have this magic internet money, right? It is great to be able to be in a position where you can do that. But realistically, if we're trying to adopt to most of the world, it's going to have to be the money that they get paid at their job. It's going to have to be the money they use to pay their rent. It's going to have to be the money that they use to buy groceries because that's the money they have. They don't have a giant pile of money to mess around with this cool new technology. And so we have to connect. If we don't connect, we will not be able to get mass adoption. It'll always be limited to a bunch of privileged rich people. That's not exciting. So I want to take a step back and I want to talk about that inflection point that I was talking about and what's going on right now. And one of the places where you can see that the most easily, I think, is with stablecoins. The current market cap of stablecoins is around $160 billion, and it's growing so rapidly that that number is, it's going to be obsolete by in months. It's expected to grow to almost $3 trillion by 2028. And this is the next statistic is, I think, the most important one. Remember, I was talking about bleeding over into popular culture. It's great if everybody in the Bitcoin space thinks Bitcoin's great. If everybody in the crypto space thinks cryptocurrency is going to take over. Everyone in the DeFi space thinks DeFi is going to be the next big thing. What about people outside the space? 97% of institutional investors believe that tokenization is going to significantly affect asset management. These are people who they're not Bitcoin people, they're not crypto people, they're not blockchain people, they're not DeFi people, they're institutional investors. These are some of the most conservative people in the world, right? And they think that the technologies that we're building are going to revolutionize their industry. That is that bleed over into popular culture. The market value of tokenized U.S. securities alone is $1.5 billion. This is a new space. So that is that number is probably different by the time I get off this stage. And of course, the growth of tokenized assets, $16 trillion forecast by 2030. I think that's probably going to be conservative. It just makes sense to get into these spaces. If DeFi spaces and tokenized spaces are where the investors are going to be or where the money is going to be, that's got to be where the assets are, right? The assets are going to chase the money. So what does Ripple think that we need for the XRP ledger to benefit from this? Well, we need core financial primitives, right? We can't have real-world asset tokenization if we don't have primitives to launch tokenized assets, right? We can't have on-chain lending if we don't have primitives for on-chain lending. And real utility has to be the guiding principle. We have to build the technologies that are the things that the market wants, right? We have to build a product that fits the market demand. Extremely important that people can build and launch compliant projects. And this is the key thing. We want enterprise projects that are compliant, but that bring customers into blockchains, right? If enterprises use the XRP ledger just for payments, That's great. That's not a bad thing, but that's not going to bring their customers onto the XRP Ledger. If they use the XRP Ledger to launch tokenized loans, that's going to bring the people who are going to fund those loans and who want to return onto the ledger. That's the difference in the sort of institutional DeFi type of adoption and the traditional institutional adoption that we've seen. We really see that with stablecoins, right? A stablecoin is probably one of the most regulated products in the crypto space. If you look at companies like Circle, Tether, the forthcoming Ripple stablecoin, these are going to be heavily regulated products, right? Most of us will never be able to get a stablecoin directly from its issuer or redeem a stablecoin with its issuer. But there are millions of people who can hold USDT, hold USDC, hold the forthcoming Ripple stablecoin, who knows what jurisdiction on. They'll be in real DeFi ecosystems. That's the difference. But it won't work if everybody has to build their own compliance. I'll talk more about that a little bit later. And developers have to have great experiences. One of the biggest problems in the XRP Ledger space is that there just are not a lot of people who are able to develop in that space. It has to be easy. It has to be simple. The documentation has to be good. The support has to be there. The tools have to be there. But if we can build those four things, we can have the foundation for an institutional grade blockchain with the XRP Ledger leading in these institutional DeFi applications where regulated products can enable deep, true DeFi ecosystems. We don't want to launch a regulated product on a public blockchain as an island that doesn't connect. There's no reason to do that. But it's obvious why you wouldn't launch USDC on a private blockchain, right? The whole point of a stablecoin, the whole point of tokenized securities, I want to use them as collateral for loans. I want to rehypothecate them so that other people can, maybe I want to tranche them so I can have different investments with different risk profiles. I want to put together a DeFi product that's backed by an institutional stablecoin, that's backed by tokenized securities, that's backed by real commercial grade lending and real estate lending. That's what the XRP Ledger could do. So let's talk about where we've gotten and where we're going to build that. I'm going to go into more detail on each of these, but I just want to give a broad description of them on one slide so that you can sort of get the vision for where we're going and where we are. So if you get too down in the weeds, you kind of lose the big picture. So big picture, we have the automated market maker. It launched in March of this year. There was a little bit of drama around the launch, as many of you know. I see some smiling faces. I'm glad we're past that, but it's working very nicely now. The lending protocol has been released. We'll talk about that in more detail, but that's another example of that sort of, that'll be very regulated lending. There'll be commercial real estate lending, but it will be tokenized on the back end, so it will enable a DeFi ecosystem. Decentralized identity, if every project has to launch its own identity infrastructure, it's just going to be terrible for everyone. Oracles are critical for things like over-collateralized stablecoins, tokenized collateral. You need to have pricing information. Multi-purpose tokens will be proposed in the third quarter. It'll fill a gap in the way assets are represented on the XRP Ledger. I'll talk more about that. And the EVM sidechain. So I'm going to go into more detail of all of these, but I think this is a roadmap for institutional DeFi. So let's start with the automated market maker, something that is extremely near and dear to my heart. As I've said many times, I've been experimenting with trading and volatility harvesting and different types of strategies for probably 30 years now. There is a tremendous amount of volatility in digital assets, and just like logically there shouldn't be, because volatility is exploitable. There are trading strategies that profit from volatility. It's really simple, basically. You sell high and you buy low. It literally is that simple. And that's what the automated market maker does. It executes a trading strategy. But the most interesting thing I think about the XRP Ledger's automated market maker is how it integrates with the other functions on the XRP Ledger into what we've been calling the super DEX. The XRP Ledger has order books. Some people call them central limit order books or CLOBs. And what that means is people place offers to buy or sell one asset for another. It's a trade. And they sit on order books to be taken by other people. Many blockchains can't implement order books because most trades are not taken. This is just the way markets work. Most people who place an offer to trade, nobody takes that offer. The price changes before anyone takes it and they rescind the offer. If it costs you $4 or even $2 to place an offer, then order books will be very, very limited to only really major assets. In fact, in some cases, there just aren't any assets that big, and order books just don't work. And so on most EVM-based chains, you just don't have order books. You only have AMMs. The XRP Ledger has order books. These are very capital efficient, for popular assets, but they're not very good for unpopular assets because somebody has to actively make a market. These facilitate manual market making. So I can make a market between XRP and a USD stablecoin by placing offers into the order books. But someone has to do that. And there's not going to be anyone who's going to do that for hundreds of assets. Automated market makers take that long tail of assets. So those on-chain order books operate 24/7, and the automated market maker executes a trading strategy that harvests volatility. So if you have an automated market maker between, say, XRP and a USD stablecoin, it will get revenue not just from market making, but also from volatility harvesting. The AMM that we designed for the XRP Ledger has a couple of unique features. One of them that I think is important is just that it benefits from the XRP Ledger's core architecture. Transactions are very cheap and very fast. If transactions are expensive, that's going to limit people's ability to interact with the AMM, and you're going to sort of lose a large number of low-value transactions. A small number of high-value transactions is good, but a large number of low-value transactions is just as good. And if you lose that, you're missing 50% of the picture. There is no MEV, there are no block producers, there's nobody who controls the order of transactions on the XRP Ledger, and that helps to prevent money from essentially being taken from the liquidity providers. The continuous auction mechanism, this is an exclusive that we developed, that takes some of the revenue that would have been given to arbitrageurs and gives them to the LP token holders. So the basic gist of this is, let's say you're an arbitrager and you calculate that you could make $100 a day. The XRP Ledger's AMM implementation sells execution privileges that allow you to do the majority of the arbitraging. So if you're going to make $100 a day from that, you have to bid for the privilege of arbitraging. And you might bid, let's say, $90 a day to make that $100 a day, which means instead of the liquidity providers losing $100 a day, they only lose $10 a day, which reduces impermanent loss and increases yield. And there's voting over the control of the pool trading fees. The lending protocol is another one of those institutional DeFi applications. It's enterprise consumer lending and real estate lending. It doesn't change the underwriting portion. And of course, if someone doesn't pay back a loan, you have to sue them. You don't sue them on chain, right? Or you have to negotiate with them. Maybe they're in bankruptcy or whatever. That is all done the exact same traditional way. What's unique is the back end, where the capital comes from and where the payments go. So the way the proposed lending protocol works is there's a single tokenized pool of the asset that's going to be lent. It could be XRP, it could be a USD stablecoin. The manager who owns each lending pool will decide who gets a loan, how much the loan is, what the term is, what the interest rate is, and they will actually approve the loan. And then the borrower will be able to extract the funds from the pool. When payments are made, the payments will be determined by the pool. So on one side, you have this heavily regulated CeFi, centralized commercial lending, and on the other side, you have a tokenized back end. The underwriting, the risk management, litigation if necessary, contract execution, all of those things take place off-chain. A unique feature here is on-chain first loss capital protection, which helps to protect the lenders in case there's a small number of the loans in the portfolio that don't get paid back or go bad. Interoperability, extremely, extremely important. As I said, I lived through the internet revolution. Everybody in this room probably has a smartphone, has home internet access. There is no one single thing on the internet that is so compelling that it's the reason that you have that. It's because everything is on the internet. If there's some information you need and it isn't on the internet, why the hell not? If information you need is not on the internet, something is really wrong, right? Everything is on the internet. Now, there are a small number of things that are tremendously valuable. A lot of people love X, used to be Twitter. A lot of people love Amazon. A lot of people love, Meta. But there's a long tail, right? There may be 30 people in the world who are gay, lesbian, and bisexual fans of Space 1999, but to them it is the most important thing in the world. And the internet can provide not just what everybody wants, but what these very small groups of people want. And that long tail is tremendously valuable. And that's what only interoperability can give us. If our users have to, imagine if you wanted to use the internet and you say, oh, that web server's on Wi-Fi and using Linux. I'm used to web servers that are using Microsoft and fiber optics. That would be a terrible experience, right? And in the blockchain space right now, you have different wallets for different blockchains. You have assets that are on different, right? It's not a good user experience. If we want to be compelling, we have to be seamless. One of the first things that we need is asset portability. That's not all of interoperability, but that's a big piece, and that's the piece we need now. And one possibility is the XRP Ledger as a trading hub across blockchains with the DEX, the payment engine, pathfinding, the various different XRP Ledger features that enable the movement of assets. In fact, one of the very first applications on the XRP Ledger in the very, very early days was as a way to move Bitcoin faster and cheaper. Issued assets enable, remote assets that are based on different chains along with bridges. So I think that's an extremely important step towards interoperability, but it's just one piece. The industry has a long way to go. But if we want mass adoption, users are going to have great experiences. We have to solve interoperability problems. The XRP Ledger could be a token bridge for asset portability, but that's not the whole solution. So I want to talk a little bit about how I think about the EVM sidechain and EVM programmability. That's another one of those things to target that long tail. So if you need AMMs, the XRP Ledger has it. If you need NFTs, the XRP Ledger has it. If you want an issued asset, you want an order book, the XRP Ledger has it. But what if you want something that's a little different? You have some weird quirk in NFTs that you need that the XRP Ledger can't support. And maybe only 10 people in the world care about it, but for those 10 people, it's extremely important. The XRP Ledger can't do that. It's a fixed function ledger. It adopts functions that are of broad, the 80% of the 20% that solves 80% of the problem. EVM can target the long tail, and we don't want to tell people who have those problems in the long tail, we're sorry, we just don't have any way to help you. Just go somewhere else. We don't want to kick them out of our ecosystem. Now, I know what a lot of people are thinking, which is like the XRP Ledger is why we're here. It's what's important. And that's true. But I just want to point out, in the early days, we celebrated every exchange listing. That is not an XRP Ledger thing, right? People who hold tokens on exchanges, they're not using the ledger, but they're using XRP. And I'm hoping that we can see the XRPL EVM sidechain. Oh, announcement. It has a name. I wanted to call it Niobium. I lost. It is called the XRPL EVM sidechain. I know that's what everybody was calling it anyway, but that is actually its name. That is a bona fide announcement. I'm not lying. It is actually going to be called the XRPL EVM sidechain. I want you to think of that as a true part of the XRP ecosystem. XRP will be its native token, and it will be able to address that long tail of use cases. And if we have asset portability, I hope we can think of it as part of the XRP ecosystem, and that the XRP is not just the XRP Ledger. Maybe that's too much to ask. So Axelar is going to provide the bridge for the native token. Anybody who wants to can provide other bridges for other tokens, but you do have to have one bridge for the native token, the gas token. That's going to be provided by Axelar. It's going to use a proof of authority consensus. It'll have a block explorer, and you'll be able to use traditional EVM wallets. It will be a traditional EVM chain. One of the advantages of being able to launch projects on the EVM sidechain is the development cycle is much faster. So it took, 2 years to bring AMMs onto the XRP Ledger? Let's say somebody said, hey, I want to do securities derivatives with leverage trading and some other weird thing on it, over collateralization, blah, blah, blah. You could maybe launch that on the XRP Ledger in a year. You could launch that on an EVM sidechain in probably 2 months, and it's much easier to find developers. So we have to be realistic. For that long tail of projects, if we don't have a place inside our ecosystem for those projects to go, they're going to go elsewhere. And so we should be inclusive. Decentralized identity is extremely important if we're going to have a large number of smaller projects. So when you think about enterprise DeFi, you think of maybe like the 10 biggest companies. So I was telling you about it before, like we had the enterprises that launch stable coins or tokenized securities, and we have all the users on the DeFi, but there is a middle, right? There's something else that's not in that picture, which is medium-sized businesses that are not going to launch a stable coin. They're not going to tokenize securities, but they're still going to do very interesting things in regulated spaces. And they're going to have some way to onboard users that can, meet KYC, AML, and sanction screening. The traditional way you would do that is you would send your driver's license or passport to every single company that you wanted to onboard with. Well, that is terrible for everybody. Why is that terrible for you? Do you trust these projects? You know, if they're small to medium, you would have to think, how good is their security? How much money are they spending on protecting my identity information? And it's terrible for them because it's a pure cost center. They don't want to have your driver's license. They don't want to have your passport. They don't want to do KYCML. They're doing it. Why does the law require them to do KYCML? Because they wouldn't do it if the law didn't make them do it, right? They're not happy about it. It's a cost center for them. If they get hacked and lose your identity information, you're not happy. Nobody's happy, right? It's a terrible system. So we need a standard. This is a W3 standard. Ripple didn't invent it. It didn't come from the XRP Ledger community. It's a W3 standard for the underlying data, and there's a standard for storing it on the XRP Ledger. So what this allows you to do is you go to a company like Fractal ID. They're in the identity business. That's all they do. They want to store your data because that's their business. This is not something they had to do to launch the business they wanted to launch. This is the business they wanted to launch. They'll go to you and they'll say, use us as your identity provider, and then you'll have an identity that all of these like medium-sized projects can use, with the XRP Ledger as sort of the clearinghouse for the reference information. So this is an extremely important enabler for that vision of enterprise DeFi. It's not just the very biggest companies on one side and all the DeFi users, but there's small and medium businesses that have to have a place too, and this is a key enabling technology for them. Oracles are another enabling technology. They're not really that sexy all by themselves. They don't do anything amazing all by themselves, but they're a critical enabling technology for things like over-collateralized loans. So if you have collateralized, or let's say you have an over-collateralized stablecoin, or let's say you use a token as collateral for something else, the system has to know the value of the things that it's holding. You need an oracle for that. Band Protocol and DIA are going to be providing oracles, but anybody who wants to can provide an oracle. The XRP Ledger doesn't discriminate against who's providing the data. There will be an actual oracle object on the ledger that will hold the pricing information and will be available for use by other ledger features. So multi-purpose tokens are interesting. The XRP Ledger currently has really three types of tokens. There's XRP, which is its own thing. It has its own rules, divisible into drops. That's the native token. You use it to pay fees and so on. There's NFTs, which are designed for things that are one of a kind. And then there's issued assets, or IOUs, that are really designed for assets that are fully fungible and infinitely divisible, things that work like money. But there's assets that don't fit either of those models, or any of those. Concert tickets are a good example. They're semi-fungible. They're not really NFTs. But you don't want to think of them as infinitely divisible. If 100 people show up at a concert and each one of them has 99.998 of a ticket, it's super awkward, right? Multi-purpose tokens have finite configurable divisibility, which has two advantages. Number one, you can support things like concert tickets that shouldn't be divided, but also you can have a specified number of decimals, which makes the math much more easily. You can have a fixed token supply. I know you can have a fixed token supply with IOU assets, which kind of have to bash a square peg into a round hole to make it work. They work nicely. Another important thing about these is the asset itself is a thing. So the way the XRP Ledger is designed, you might think of an asset as a thing. So for example, Bitstamp issues USD on the XRP Ledger. We think of Bitstamp USD as a thing, but the Ledger doesn't think of Bitstamp USD as a thing. From the Ledger's point of view, there's a bunch of people who Bitstamp owes money to. And the asset itself is not a thing. It's very much like your balance on the Bitcoin blockchain. If you have an account on the Bitcoin blockchain and you have a balance, there's no such thing as accounts or balances on the Bitcoin blockchain. Usually we think of it. An account is all the UTXOs that can be claimed by the same private key. A balance is the total of all those, right? Assets are not, issued assets are not a thing on the XRP Ledger. They're just like balances or accounts on Bitcoin. But with MPT, with these assets, the asset itself is a thing, and so it can have properties. So as you see on your screen here, this is an example of an asset that has properties. It has a supply. It has decimals. It has a symbol. And all of this is represented on the ledger. There is currently no asset, there's no way to do that currently on the XRP Ledger. So MPTs will enable this sort of more flexible type of asset. The token will be a thing, so it will have a token ID. Tokens can be made non-transferable if they're things that represent, information that is not value.
Yo, let me tell you about a pioneer, David Schwartz in the blockchain sphere. From the roots of code to the heights of fame, in the digital ledger, he made his name. In the shadows of Jersey, where tech dreams start, David Schwartz, with a mind and a heart, engineering talent, a vision so grand, he saw the future in the blockchain's hand. From computer whiz, a cryptographer's rise, in the world of data, he opened eyes. Early days in tech, foundations laid, in the dawn of digital, his journey played. With lines of code, he shaped the flow. In the realms of crypto, his influence grows. From humble start to the leading edge, David's work in the digital pledge. David Schwartz, the ledger's guide, architect of change in blockchain's tide, XRP's creator in the crypto beat. In the world of DLT, his legacy's neat. In the heart of Ripple, his vision bright. In the blockchain's dawn, he lit the light. David Schwartz, where the digital reigns, in the ledger's truth, he broke the chain. He joined the Ripple crew in 2011's gleam. With Chris and Jed, he fueled the dream. XRP Ledger, born from his mind, a decentralized system, one of a kind. Trust lines and payments, all set to flow. In the world of finance, the old ways go. The ledger's built, fast and secure. David's code in the blockchain's core. Decentralized, where transparency stands. In the realms of Ripple, it's in David's hands. No middlemen, just the blockchain's grace. In the world of DLT, set the pace. David Schwartz, the ledger's guide, architect of change in blockchain's tide, XRP's creator in the crypto beat. In the world of DLT, his legacy's neat. In the heart of Ripple, his vision bright. In the blockchain's dawn, he lit the light. David Schwartz, where the digital reigns, in the ledger's truth, he broke the chains. David's mark on DLT, in every thread, innovations in code, where the path was led. From the algorithms deep to the consensus high, in the blockchain sky, he dared to fly. Secure and scalable, transactions swift. In the world of finance, he gave the lift. Ripple's protocol, in the cryptographic scheme, David's influence, a coder's dream. Beyond just tech, his voice was strong in the debates on crypto, where it belongs. Advocating freedom in the digital age, David's wisdom on the global stage. From conferences to interviews, his vision shared. In the blockchain's future, his legacy bare. A voice of reason in the crypto seas. David Schwartz's influence, the world agrees. With lines of code, he shaped the flow. In the realms of crypto, his influence grows. From humble start to the leading edge, David's work in the digital pledge. David Schwartz, the ledger's guide, architect of change in blockchain's tide, XRP's creator in the crypto beat. In the world of DLT, his legacy's neat.